Inflation easing, China reopening, and Africa waiting. But all anyone can talk about is Samuel Bankman-Fried. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on easing inflation and whether we're on our way to that soft landing.
Chairman is in about the right place. I think we are in better shape than I thought we were.
And Rick Rieder of BlackRock on the historic opportunity he sees in fixed income.
If I can lock in these yields, go a little bit longer without having to go out to 10s or 30s, that to me is the sweet spot today.
There was a lot of news this week for Global Wall Street, but we found ourselves spending just about all of our time focused on FTX and its former CEO, Samuel Bankman-Fried, as its current CEO bluntly told Congress what had happened.
This isn't sophisticated whatsoever. This is just plain old embezzlement.
And some members of Congress, like Brad Sherman of California, said we should just do away with cryptocurrencies altogether.
What does cryptocurrency have over the US dollar or other major currencies? It's right there in the name. Crypto, hidden money. My goal is to say enough is enough. It's time to prohibit Americans from investing in crypto.
President Biden convened a summit in Washington to deal with Africa, with Secretary of State Antony Blinken emphasizing cooperation.
Partnership is at the heart of President Biden's strategy for Africa. Partnerships between the United States and African nations, with the private sector, and between our people.
But Ian Bremmer of Eurasia Group said that the United States has to work to catch up with China when it comes to Africa.
The Chinese invest a lot more. But the African governments want to see the money. They need the baseline infrastructure. And so far, the Chinese have done a lot more on the ground to invest.
Secretary Granholm announced that the Department of Energy had made a major breakthrough in nuclear fusion.
This demonstrates it can be done. That threshold being crossed allows them to start working on the things that are necessary to allow it to be modularized and taken to commercial scale.
And Elon Musk gave up his title as the world's richest man, at least for now.
He's no longer the richest man in the world. If you look at Tesla stock specifically, their market value now falling below $500 billion.
But for all the drama, the big news really came from the central banks, starting with the Federal Reserve. On Tuesday, the Fed got the good news that inflation was slowing faster than we had thought.
Investors didn't think inflation was going to come down as fast as economists were forecasting, and now it's coming down even faster.
And on Wednesday, the Fed responded by saying, well, not so fast. It's good, but not good enough to declare victory.
The FOMC raised our policy interest rate by 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way.
And then on Thursday, the Bank of England and the European Central Bank raised their own rates, another 50 basis points each, with ECB President Christine Lagarde saying they won't be taking their foot off the brake anytime soon.
We should expect to raise interest rates at a 50 basis point pace for a period of time.
And the markets, well, as much as they were encouraged by those CPI numbers on Tuesday, they were just that disappointed by the Fed chair's reaction, as stocks were down again for the week, with the S&P 500 losing just over 2%, the NASDAQ off 2.7%, while the yield on the 10-year was down just over 9 basis points to end the week just under 3.5%. Take us through this combination of economic and market data. Welcome now JoAnne Feeney, partner in Advisors Capital Management, and Sonal Desai, Franklin Templeton CIO of Fixed Income. So, JoAnne, let me start with you. Did I detect just a wee tension this week between, on the one hand, the markets and on the other, the Federal Reserve?
Yeah, just a little bit, David. You know, we've seen this play before. The market gets all excited. They see a data point and they think, okay, the Fed's finally going to ease off or signal that it'll ease off. And then we get that bucket of cold water. The fact of the matter is there's just a lot of work for the Fed to do to get back to that 2% target. And, they're going to keep rates elevated and continue to raise until they have a much clearer and broader signal. And one CPI print is not going to convince them that the hard work has been done. There's just too much in terms of labor shortages right now driving wage growth. for them to ease off on this effort to constrain economic activity.
So, Sonal, the Fed has been fairly explicit. Why doesn't the bond market believe it?
So, I think that it's a question of what you call credibility. Is it credibility? Does the Fed have credibility that it's going to fight inflation? Or is it more that the market does not believe the Fed has credibility to stick to its guns in terms of raising rates? They're not taking the Fed very seriously, right? We are looking at what markets are pricing, both in terms of the peak Fed funds rate, which is not 5, certainly not between 5 and 5.25, as the SEPs are describing. It's below. Didn't change after Chair Powell's Q&A. And furthermore, the market's still pricing in rate cuts by the end of next year. We're looking at 4.35 for Fed funds at the end of next year. So I think the Fed has a problem. It's got its work cut out for it. Markets have been conditioned to actually not believe the Fed when it says it's going to be really tough.
So, JoAnne, given this disagreement, if I can put it that way, what does an investor do? It does strike me that bonds are a lot more attractive at the end of the year than they were at the beginning. I think the yield was something like 1.8 at the beginning of the year, and we're up around 3.5 now.
Yeah, there's no question that finally investors can look to bonds to really fill an important role in their portfolios. Not only are they getting decent income off the bonds, and that's allowing them to build more balanced portfolios, so that they can both stay in equities to some degree and hopefully get that long-term appreciation that they need. But now they're getting some decent income on the fixed income side, which is a relief. Right now, real yields are negative because inflation is running ahead. But when you look to the longer term, out 2, 3, 4 years, those real yields now look positive, and they're really going to help purchasing power for those investors going forward.
So now there is a lot of volatility, though, in the bond market, is there not?
There really is. There is a lot of volatility, and honestly, until we get to a stage where the market starts buying whatever it is the Fed is selling, I think we're going to keep seeing these moves, which are remarkable. If you look at 10-year yields, which I think over the month of November went at one point from 4.25 all the way down and then back up. We've seen around 70, 80 basis points of moves, up to 30 basis points in literally days, 20 basis points in the last few. You look at this level of volatility, it's almost too much, far too much. And as I look into next year, I think it's probably going to be a few months, at least maybe a quarter or two, until we see the Fed having raised, before we see some reduction in volatility. Nonetheless, echoing what JoAnne said, when you're getting yields in areas such as high yield, for example, you're getting as much as 9 to 10% on low dollar price bonds. Certainly, there are specific bonds, specific areas which look attractive, but I don't think I would go wholesale into adding risk. It's actually quite a nice time to be low in duration and high in quality in the bond market.
Well, let me pursue that if I could for a moment, Sonal. This is the end of the year, so we traditionally say, what's your conviction trade going into next year? What's your conviction trade given that volatility in the bond market?
Oh, no, I think my conviction trade on fixed income overall is high. I think I like to stay, like I said, relatively short duration, high in quality. I do like investment grade. And I think fairly soon into the new year, we're going to start seeing very attractive opportunities within the first quarter or quarter and a half. We're going to see some good opportunities in riskier segments like high yield as well. Emerging markets look very attractive too.
So, JoAnne, what about you? Do you take your incremental dollar and put it into bonds right now rather than the stocks, given where bonds are? They're much more attractive than they were, as you said.
We've already seen that happen a little bit, but right now, it's not that the equity markets are particularly cheap. Volatility has been high. The bond yields are certainly more attractive. So again, a balanced strategy, at 70-30, 60-40 can do a lot for clients. And so that incremental dollar really depends on the client's horizon. Obviously, a shorter horizon client had better be more in bonds at this point, despite that bond volatility that we're seeing and likely to continue to see. And while the stock market isn't particularly cheap at roughly 18 times forward earnings, and those earnings likely to come down some more, there are still some very attractively priced stocks out there. Conservative companies that pay a dividend, that offer dividends that go up year after year. And that's another way of creating income for investors in the short term, even while equities remain a bit volatile. So if you can wait it out, you can get both the dividend income, perhaps well above the market average, to ride this out, and then still be positioned to have a portfolio on the equity side that's going to really help the portfolio appreciate over the next 3 to 5 years.
Okay, so now one quick one to you. I know you're fixed income, but do you think the equity markets have really taken into account the decline in earnings that's coming?
Doesn't appear so. So from my equity colleagues, I hear that essentially we haven't seen major earnings downgrades. Now, while I don't expect a major recession next year, some slowdown in the second half of next year is pretty much a given. So not sure that earnings downgrades have been factored fully.
Okay, thank you so very much to Sonal Desai of Franklin Templeton and JoAnne Feeney of Advisors Capital Management. Coming up, we're going to talk with Rick Rieder of BlackRock about what has already been an eventful year for markets and why he sees an historic opportunity in fixed income. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. 2022 has been a year of change in the Fed and other central banks pulling back support for the economy and the markets, change in the stock markets as they adjust to the central banks, change in the rate of inflation and the underlying economic growth. Take us through what we have seen so far this year and to look forward to what may come next year. Welcome back, Rick Rieder. He is BlackRock CIO of Global Fixed Income and Head of Global Asset Allocation. Rick, welcome back. First of all, the big news on Global Wall Street this week was you got a promotion. You're on the Global Executive Committee now for BlackRock. Congratulations.
Thank you, sir. Yeah, I appreciate that. Thank you very much.
A lot more stripes and epaulets. So talk to us about the change we've seen, because there has been a lot. If you look back to where we were January 1 of this year, where we are now, it's really different. For example, from 0 to 3.75%, even higher than that, 4.25% on the Fed.
Pretty incredible. Actually, when you go through, I've been doing this almost 36 years, and you say, what were the years that you had this sort of change? 2008, maybe still the biggest, but this ranks right up there at the top. You think about, we came into the year in March. The Fed was still doing QE and had the funds rate at 0, and now we've priced the funds rate at about 5 as a terminal. I mean, that's pretty extraordinary, and a year that you've never seen, nobody's ever seen, even in my long tenure in the industry, where the bond market and the stock market all traded down. So your hedges, how you did portfolio allocation, change of leadership in the UK and all of the pension system dynamic, a war that, who thought that we'd go through a deglobalization process and the impact that has on inflation, impact on fuel costs, food costs. I mean, this is extraordinary.
And that's before you get to China.
And by the way, I didn't even think about that. And the emergence from COVID, not emergence from COVID. Now do we start to grow? I mean, it is pretty extraordinary. It felt like 5 years wrapped into one.
So the economy has absorbed a surprising amount, actually, if you think about what's happened here. Can it absorb what's going on right now? I mean, what are your prospects for as the so-called soft landing at this point?
So, David, I think people underestimate how flexible, adaptive, innovative, particularly the U.S. economy is. Harder in emerging markets. You saw a year where the dollar appreciated, emerging markets come under stress. But I think people underestimate how darn flexible, and you're seeing it play out in the U.S. economy. Think about when we emerged from COVID, all of a sudden people needed a TV, electronics, furniture, massive goods grow, and you saw jobs moving in the goods sector. Then people had already gotten what they needed to get. They didn't need another computer or TV. Now you shift to the service sector, growth from the service sector, and you're seeing jobs, leisure, restaurants, hospitality, healthcare that are now starting. It's pretty extraordinary. So can the economy withstand this? Listen, this is a historic move up in interest rates, tightening of liquidity through the balance sheet channel. But yes, I think we've talked about on your show, I just don't know why soft landing is like landing the plane on a pin needle. It's you have an economy, you have a savings rate that's still in good shape. Leverage in the system, I've gone through 2002, 2008, where you had too much leverage in the financial system, consumers, corporates. Leverage is in pretty good shape. So the economy has a series of buffers alongside of it. Listen, is the economy slowing? Could we have a shallow recession? For sure. But I think people underestimate a developed economy, particularly like the U.S., is much more reflexive than people give credit to.
Rick, you said the economies were resilient. How resilient are the markets? Because you mentioned one of the issues that we've talked about before, which is liquidity. A lot of liquidity coming out of the markets. Have the markets held up? Are they prepared for what comes next?
So I'd say the markets are less adaptive and flexible. And I've learned over my career, there's a cultural dynamic around markets. People don't like to lose money, but of course they don't like to lose money, but it's not symmetric to making money. I've always found this, markets go down 5 times faster than they go up. People like to protect what they've made and don't like to lose money. And when people think the prospects that they could lose more money, markets go down even faster. And it's pretty extraordinary. We witness that. And I've always found that people buy on up markets and sell on down markets because they just can't take the losing more money. Now, we're at a place today that if the Fed starts to come off the boil, which I think is the case, that now we're talking about rate volatility on the risk-free rate on interest rates, that's going to come down a lot. That gives, there are two components, particularly in fixed income, and any assets, the risk-free rate plus your risky rate. And we always think about whether it's debt, equity, where's my risk-free rate and where's my risky rate. But if your risk-free rate is moving all over the place and moving higher, you can't value any financial asset. If that stabilizes, risk premia, term premia comes down, and I think that's a really big deal. But are we going to have some vol into next year? Yes. I just think less than 22 if the Fed pauses. And by the way, the ECB starts to tone it back, Bank of England, et cetera.
Well, you talk about the Fed coming off the boil. It looks like at least they're going to slow down the rate of increases. I'm not sure they're going to cut right away, but slow down the rate of increases. What do the economic numbers show us about that? Because we did get CPI numbers out this week that a lot of people reacted to very favorably.
So it's really encouraging. By the way, we've had head fakes before. We had it in the summer. It would look like, okay, we're on the backside of it, and then all of a sudden it popped up again. I don't think it's over around what is elevated rates of inflation. You see it through wage stresses in the system. That being said, when we break down the component parts of inflation, you think about shelter, you think about food costs, used cars, supply chain, freight costs, they're all coming down. So you take some comfort in that we're on the backside of the elevated inflation. We've run some numbers that even if inflation in most products stays elevated 4 to 5%, because of where energy is today, because of how much it's come to worse than where it was, because of house prices, shelter coming down, we still get in the high 2s in inflation by the middle of the year. So you can live with that. And it's part of why I think the Fed, if the momentum is moving in that direction to a more normalized state, although elevated from history, Fed can pause. But you made a critical point. The markets are pricing the Fed's going to start easing in 23. I don't think that's right at all. I think the Fed's going to sit with this for a while in a restrictive policy. Maybe in 24, 25, you'll start, not maybe, I think in 24, 25, you'll start normalizing rates back down again. But we're not going there yet.
Rick Rieder, BlackRock, is going to stay with us because we're going to talk about something he calls a generational inflection point on fixed income. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We are back now with Rick Rieder of BlackRock, and we talk about what Rick is calling potentially a generational inflection point for fixed income. So what is that generational inflection point?
I've said this before, I've never been more excited coming into a year at 23. First of all, 22 wasn't a lot of fun in a lot of the markets, but now, when you put in perspective where we are, for the last 10 years, the short end of the yield curve, the 1 to 3 year portion of the aggregate index, the benchmark for fixed income, the average yield was 1.10%, 1.18%. The last 3 years is 1.10%. We're talking about 4.5 now. So you've got an opportunity where you can, in fixed income, you can buy yielding assets, and you don't have to stress around illiquid, really deep down in leverage loans, really deep down in parts of emerging markets. You can build a portfolio, investment grade credit, some of the AAA parts of credit card finance, student loan finance, et cetera, and you can create 6 to 6.5. That is, we haven't seen that. Gosh, it's been, since the 80s, 90s that you've seen those sort of yields by buying quality assets. David, that is a critical moment without taking a lot of interest rate risk, without taking a lot of beta risk, without taking a lot of convexity risk. And you think about what does that mean for equities? What does that mean for private equity? If you can get 6-ish in high quality assets, even a bit higher than that, it means, boy, you got to get higher numbers, significantly higher to take liquidity risk, volatility risk, et cetera. It's a really big deal. Money's going to flow into fixed income as a result of it.
I want to come back to equity and private equity. Before that, duration. Is there a particular duration you're looking at that's more attractive?
Yeah, obviously with the inversion of the yield curve, it's been, you can capture, and this is part of the beauty of it, you don't have to take a lot of interest rate risk. So many times in my career, you've got to, go out to the 10-year part or the 30-year part to get your yield. The curve's inverted. You can stay in the front end if you believe, which I think is right, the Fed is going to pause. You get to a place where, gosh, I'm just going to try and clip that yield. What we've been doing and I think we've been talking about this show, that we've stayed short. We've run a lot of cash this year. Cash has been our best performing asset at a lot of, you think about the financial markets. Now we can go a little bit longer. Can you go out to 3 years, 5 years? Because the next evolution of the Fed will be easing. Again, I don't think it's till 23, till 24, 25. But if I can lock in these yields, go a little bit longer without having to go out to 10s or 30s, that to me is the sweet spot today.
Rick, you mentioned corporate investment grade. You mentioned possibly high grade credit card. What about sovereigns?
So, we've added a little bit of emerging markets recently. I think one of the big things that we didn't touch on last year was the dollar. Massive appreciation of the dollar, Fed's moving aggressively, money's flowing into the dollar, and not just in fund flows, but in terms of corporate spend, et cetera. I think the dollar is going to be more stable. I'm not ready to say the dollar is going to weaken significantly, but I think we're on the backside of real volatility. So parts of the emerging markets, Mexico, Brazil, Indonesia, you're getting some nice yield. And so I think you need to diversify it a bit more than historically, because there's been stresses, and we're not out of the woods in a slowing economy. So do you hold some emerging market sovereign debt? I think you can more so today, but gosh, I sleep really well at night knowing if I could buy 6% yielding assets that are high quality, investment grade, AAA securitized, how much EM do I really need? So we've been buying some, but not that aggressively.
Well, and to follow on that, how much equity do you need? How much private equity do you really need? Because you were referring to that earlier. When you get those kinds of yields out of fixed income, it makes it awful hard to justify equity.
So, I always value equities based off of obviously what the earnings growth is going to be, but I also need to know what my alternative asset suite is. And companies borrow, and if they can't borrow at an attractive rate, it's hard to do M&A, CapEx, buy back their stock. And today, it's really hard. Where borrowing rates are. So as an investor, it's symmetric. I'd rather just own that yield. Listen, if I have a long term in anybody's portfolio, you're going to have equities. You're not looking at things for the next 3 months, 6 months, 9 months. You need to have equities longer term. But if you said to me the marginal dollar, people talk about 60-40, the marginal dollar shouldn't be 60-40. The marginal dollar in this environment should be much more heavily weighted. But let's get that yield in. And then the hurdle rate that I pay for illiquidity, if I got to lock up an asset for 10 years, and if I can just clip 6.5 in a stable way, boy, you got to lift that hurdle rate to the mid-teens to really want to take that risk. And so I think that's working its way through the system today.
But those rates also put pressure on equities and also private equity in two other ways, don't they? Number one, discount rate applied to equities, which makes it less valuable, all things being equal. And private equity, as they go out and they're trying to borrow money to make deals, it gets a lot more expensive than it has been in the past.
So people underestimate that is a really, really big deal. It's your rollover financing that is hugely, and so many assets that go into private equity, they get geared effectively. You think about the most acute form of that is anything attached to real estate. Commercial real estate being the most acute form thereof, but residential as well. That's where it's built on gearing. And this is one of the things that I've always argued the Fed has to be very careful about how aggressively you move it up, because that gearing that doesn't sit in the banking system the way it used to sits in the broad economy. And when you ratchet up, and you've seen it in the last couple of weeks, some of that stuff's starting to break a bit. And it's why the Fed has to be sensitive to what is outside the banking system.
And you may not even know what it is because you're not necessarily marking to market the same way you do in a public market.
That's right. Until you have to roll over your financing, and roll over your financing, and/or put, if you're in a project, how much more capex am I going to put into a project? How much more refurbishing of the building am I going to do if I'm not fully leased up? Those things are starting to make it, when the economy was doing extremely well, rates were low, that lease rates were going to expand. But now when you're going the other way, really tough, really tough.
Rick, it's always such a treat to have in Wall Street Week. Thank you so much for being here. It's Rick Rieder of BlackRock. Coming up, we'll go through the week with our special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David West, and I'm joined once again by our very special contributor to Wall Street Week. He is Mr. Larry Summers of Harvard. So, Larry, welcome back. We have to talk about what happened this week. Before we get to China, because last week you told us we were going to get to China. But first, what happened this week? We got the numbers in on CPI. We got retail sales numbers, and they tended to indicate that maybe inflation's not quite so bad. And then we heard from Chair Powell, and he got up and said his mind wasn't changed. Was your mind changed? As you looked at these numbers, do you think maybe we're a little better shape than we thought we were?
Yeah, look, I think we are in better shape than I thought we were. But I think the chairman is in about the right place. He's recognizing that we can't forecast the economy with precision. He's recognizing that it would be a terrible error if we were to fail to stop inflation in this episode. He's rejecting the talk about this being a moment to change the inflation target, and he's maintaining substantial flexibility with respect to the future. I think that is broadly the right place for him to be. But I think we've got a very difficult challenge ahead of us, because I think the old adage about things taking longer to happen than you think they will, and then they happen faster than you thought they could, is really operating with respect to the forecasted recession. It does look like it's pushed back a bit in time, but there are reasons to think, and this is what makes the chairman's job so hard, that the economy could have a kind of Wile E. Coyote moment, that recession-induced low earnings could pop into focus for stock market investors with adverse consequences for the market, that consumers could deplete their hoard of post-COVID savings, that there's growing reason to think that many businesses are holding on to workers because in this labor-short economy, they're afraid that if they fire them or they let them go, they won't be able to replace them. If that last thing is true, then it could all of a sudden change very dramatically if labor markets start to loosen. So I think the broad picture is where it was. I've been gratified to see the ways in which the Fed has caught up, but they've got very challenging judgments to make going forward, and I think they're in broadly the right place. The last thing, though, I would say is, everybody is getting enormously excited about whether the dot plot is calling for 2 increases from here or 3 increases from here. This is kind of the narcissism of small differences. Compared to a year ago or a year and a half ago, when the debate was 3 percentage points, 300 basis points off of where things have turned out to be, we're now in a much narrower consensus around judgments, and we need to appreciate that. And it will be great if the Fed turns out to be highly skillful. But frankly, with everything going on in the world, this is a case where, as Lincoln said, we really want luck in our generals and luck in our leaders, because this could go a lot of different ways.
Larry, you promised last week we would get to China this week, so let's talk about China. Last week we saw the COVID zero policy sort of changing. This week we're starting to see, at least anecdotally, some of the consequences of that. The reports actually that a lot of China is shutting down. Some people are saying Beijing's like a ghost town. So what potential effect does that have on the rest of us, on the U.S. economy, on the global economy? What should our response be?
It's extraordinary the way mandatory lockdowns are now giving way to voluntary lockdowns, with people staying home more than they were a few weeks ago in China. I think it's going to be a very challenging 6 weeks ahead of us in China, and it will be fascinating to see what that means for social stability, what kind of political ramifications that has, and it's likely to be a very painful period for China. 2 things for us to remember in the United States. First, even if this works out very badly in China, at the end of the day, the Chinese fatality rate from COVID will have been half of what it was in the United States. And so we need to resist any strong tendency to feeling highly superior here. Second, precisely because this is burning so out of control, my guess is that it's likely, like the fastest burning fires, to burn out more quickly rather than more slowly. And so I think, ironically, a consequence of this is probably to lead to some upwards revision on Chinese economic forecasts beginning next spring. And that's a factor tilting a little bit towards higher commodity prices and a little bit more inflationary pressure globally. But that's a highly uncertain judgment. And of course, how all this plays in a broader social sense in China will be very, very important.
Larry, last week you brought a longer view with respect to ChatGPT, that artificial intelligence, I will call it phenomenon right now. But this week we have yet another development, and that is fusion, where in that Lawrence Livermore lab out in Northern California, they actually managed to have a fusion reaction where, as I understand it, they got more energy out than they put into it. So last week, when you were talking about AI, you said that had the potential to be as significant perhaps as fire or the wheel. Where does this rank?
I think not remotely comparable, David, and of course I might well turn out to be wrong. Here's why. There's a fundamental difference between innovations that give mankind the capacity to do things they've never been able to do before, on the one hand. That's what AI is. And innovations that give mankind the ability to do what we've done before forever, cheaper. That's what fusion potentially is. And the first, like fire and the wheel, are much more fundamental than the second. So I'm gratified by the second, but my read is that we've got a long, long way to go before this is available at scale, and that the reports reports this week actually reminded me of all the stories you can read in the 1950s when the first fission nuclear reactors were being built, about how energy was going to no longer be metered because it was going to be so cheap to produce. And it turned out that that didn't really work because there were capital costs, there were transmission, there were all kinds of things. My suspicion is that this is both less fundamental than something like AI or quantum computing, and that it is ultimately going to prove to be quite a long way off. But the only thing that's harder than forecasting inflation and unemployment is forecasting the long run of technology. So I sure hope it plays out to be even better than that. Kudos to the researchers involved. And it certainly does bear out something we've said on this show, that if we ultimately succeed with respect to climate change, it's more likely to be because we find ways to produce clean energy cheap than it is because we make carbon extremely expensive.
Thank you so much, Larry. Our special contributor, Larry Summers, will be staying with us because we will be joined by Paul Tucker, the former deputy governor of the Bank of England, about his new book, Global Discord. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It has been a year when history has been made, from Russia's invasion of Ukraine to the rise of inflation in much of the world to the withdrawal of massive fiscal and monetary support. Former Bank of England Deputy Governor Paul Tucker takes us through these issues against the backdrop of history and political philosophy as well as economic theory in his new book, Global Discord, Values and Power in a Fractured World Order. And my friend and colleague, Larry Summers, joins us now in welcoming Mr. Tucker to Wall Street Week. So thanks for coming, Paul. It's a fascinating book. I recommend it to everyone. We can't go through it all, unfortunately, because there's an awful lot in there. But you really do set out a rubric, a framework for looking at issues, international global issues of economics as well as foreign policy, and certain ways of discerning what is going on. Let me ask you a specific question, maybe put it through that rubric, and that is U.S.-China. We have what some people call the Thucydides trap right now, where the second largest economy is overtaking the first. What does your approach tell us about what is going on there and what should go on?
It's certainly a challenge of a rising state, but it's more than that. It's more than Second German Reich versus Britain at the turn of the 20th century. This China is a state which has a completely different ideology of government and foreign policy. Something that most people missed in 2013 was the leaked infamous Document 9, which contains 7 no's. And actually, it was a creed against liberal democracy and everything that we stand for. Where this takes me is this is going to be a long drawn-out contest, a long drawn-out struggle. I think it will be a century or more like Britain and France over the long 18th century. It will be everywhere and it will be in everything. If China has a bad few years at some point because of the fragilities in its economy, it has critical mass in everything. It will be back. I can quite imagine that people in the West will be kind of thinking it's all over in a few years' time, but in fact that won't be the case. What it means for policymakers is that we can no longer live in a world that both Larry and I inhabited in different ways, where policy can be approached in silos. A concrete example of that would be at the moment in the United States, there's a debate within the Beltway about the debt ceiling. This is a foreign policy issue. Were the US somehow to find itself in technical default, this would be a blow not only to its international prestige, but a blow, perhaps a small blow, but a blow nevertheless to attitudes around the world to the dollar. And yet the dollar is actually integral to the capacity of the United States to provide a security umbrella for my part of the world and Europe and for East Asia.
Let me start by just congratulating you on your book. Keynes famously said that policymakers are distilling the frenzy of past academic scribblers. You are the rare policymaker who goes on to become an extraordinary academic scribbler. Say something, if you would, about, as you think about in this philosophical way you lay out in your book, give us a lesson from something you think that if policymakers had understood all that you say, they might have acted differently in the past. And after you do that, we'll get to a warning for the future.
Okay, and thanks, Larry. That's very generous of you. An example would be the terms of China's entry into the WTO, the World Trade Organization, given the design of the WTO. So the point I'm going to make marries 2 principles. One is we should avoid wishful thinking, and the other is that we shouldn't just think it's a matter of state survival. This is a matter of survival of our way of life and therefore of our values. So the case about Chinese state-owned enterprise subsidies to exports a decade ago now was explosive between Beijing and Washington, because Beijing was providing subsidies to exports via state-owned enterprises, but the appellate body of the WTO decided that actually they weren't public policy bodies, and therefore it wasn't against WTO rules, and therefore the US couldn't raise tariffs in response. The problem with this, deep down, was that what one would expect ordinarily is that in those circumstances, the case is decided, it's bad news for the US, in some respects it's bad news for Europe, but Washington and Beijing then go to the bargaining table, perhaps with Europe there, perhaps with Japan and others there, and they reach a kind of accommodation where they both give a bit, and that becomes the new norm that is reflected in forward-looking policy for the WTO. But that's impossible, because every single member of the WTO has a veto. So the problem with the WTO is that its basic design assumes that the people that drew it up were drawing up the perfect contract, and that the judicial body of the WTO would interpret it in an essentially classical liberal way forever, and that didn't happen. And the failure of US policy, as I see it in this area, is that that possibility wasn't contemplated when the terms of Chinese entry were negotiated, because it was assumed, effectively, that economic liberalization introduced by Deng Xiaoping would lead to political liberalization. And that wasn't a crazy thought, but it was not sensible. It was wishful thinking to put all one's chips on it.
So, Paul, let me pick up on that, because in reading your book, and I agree with Larry, it's a fascinating book, really a commanding book in this area. What could we do better and different next time? Because one of the things you talk about is the legitimacy of some of these international arrangements. And if you get too far over your skis and away from where your basic values are and where your people are, you're in trouble. Many people in the United States think that the WTO move with China did not work out. We thought they were going to come to us in who they were. They didn't. So going forward, if they're going to remain very different in their fundamental values and the way they run their system than us, how do we deal with them?
I think one has to be imaginative about downside scenarios as well as upside scenarios. It means in the trade sphere that probably for the near future, by which I mean the next 10 to 15 years, the action is going to be in regional preferential trade agreements. It means it was a tragedy, by the way, that President Trump didn't go into the Trans-Pacific Trade Partnership. It also means, if I go back to my old world, the world of monetary policy and financial stability, the West cannot afford another financial crisis. That when people are lobbying Congress to relax this or relax that, and it concerns the resilience of the financial system, don't do it.
You make an important point about the WTO, but a tragic sensibility needs to infuse these things. And the option for the United States of excluding China entirely from the WTO, winning zero concessions from China on anything, and nonetheless being bound by the commitment that it had de facto made to provide all the benefits of WTO accession to China through MFN, would also have been a highly problematic step in 1999 when that decision was made. And so I think your argument will require a credible alternative path rather than just making the argument that there have been some adverse consequences that have followed on the particular agreement that was reached.
I think, one tiny thing, and we shouldn't get too detailed, would have been to be tougher in the agreement about the prospective treatment one day of Chinese economy as a market economy, and the ability of, even more importantly, the ability of China to self-classify as a developing economy. That there isn't an objective test for that. Essentially, economies can self-elect or self-identify as developing. And, what we've learned both with COVID and I think with China is, although the word exponential is one of the most frequently used words of our generation, very few people actually realize that exponential growth is very, very rapid growth indeed. And it wasn't sensible to leave China with the option of self-identifying as a developing economy, given the prospect of exponential growth.
Unfortunately, we're going to have to leave it there, but thank you so very much, Paul Tucker, former Deputy Governor of the Bank of England, for coming to us with your really fascinating book that I think everyone has to take a serious look at, and that is Global Disorder. And of course, thanks to our very special contributor here at Wall Street Week, he's Mr. Larry Summers of Harvard. Still to come, maybe we all could use a little more nuclear fusion in our lives, or at least someone to make sure the energy we're using is worth it. That's next on Wall Street Week. I'm Bloomberg. Finally, one more thought. Saving your energy. The world got some big news out of the Lawrence Livermore Labs in Northern California this week. For the first time ever, scientists have managed to create a nuclear fusion reaction that generated more energy than it consumed.
A fusion reactor on the grid would be a complete game changer.
And former EPA Administrator Christine Todd Whitman says it may be a step towards saving the entire planet.
This is a big step forward, and fusion can certainly offer a major tool in the effort that we need to make to address the issue of climate change.
But as exciting as saving the planet would be, it's also pretty remarkable when we find anything at all that gives us more than we put into it. Take, for example, the case of Elon Musk. And I don't mean just the money and effort he's putting into Twitter and whether that will ultimately be proved worth it. Remember all the energy his team put into showing us that the window on the Cybertruck just could not be broken.
Maybe that was a little too hard.
That sure didn't give him more than he put into it. Or for that matter, those midterm elections. Sure, we managed to have a national election without an insurrection, which counts for something.
Democracy won because we had massive turnout across the country.
But it cost billions of dollars to do it. Now, don't get me wrong. Free and fair elections are the life's blood of a democracy. But it is not always clear that they generate more energy than they soak up. And this week, the same week we made nuclear fusion work, we had one of the biggest examples around of something soaking up a whole lot of energy and money and not coming close to returning what's being put in. I'm talking, of course, about Samuel Bankman-Fried's FTX, backed by so many celebrities.
Celebrities haven't been isolated or immune to the fallout. Details on the sports stars that have been entangled in the FTX mess.
And attracting billions of dollars.
More than 1 million customers had funds tied up, and more than $3 billion were owed to 50 creditors.
But wait, there's more, because mining for all that cryptocurrency not only uses time and money, it also is pretty much a black hole soaking up energy, making the entire planet worse off.
Every transaction that you do takes more resources than the transaction you did before. It is fundamentally and intrinsically inefficient, and that is a huge energy cost.
But maybe if we can get that fusion thing going, we can save the planet. Though it probably comes too late to save Mr. Bankman-Fried. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.